Hey everyone, and welcome back to the channel. Today we're diving into a story that isn't just financial history, it's an epic corporate drama that played out like a Hollywood blockbuster. Imagine 1988, big hair, big shoulder pads, and even bigger ambitions on Wall Street. This was a time when the rules of corporate ownership were being rewritten, often with a pen dipped in vast amounts of debt. We're talking about the mother of all hostile takeovers, a deal that redefined corporate America and made leveraged buyout a household term. Our story begins with RJR Nabisco, an American industrial titan. Picture it, a sprawling conglomerate that sold everything from Camel cigarettes to Oreo cookies and Planters peanuts. This was a company deeply rooted in American consumer culture, a seemingly unshakable giant. But by the late 1980s, its stock price was stagnant, its various divisions undervalued, and its management, led by CEO F. Ross Johnson, was growing increasingly restless with the slow pace of change and the constant scrutiny of public markets. Ross Johnson, a man known for his lavish lifestyle and bold decisions, believed RJR Nabisco's true value wasn't reflected on the stock market. He saw an opportunity not just to restructure, but to take the entire company private. This was his vision: unleash the company's potential away from quarterly earnings reports and impatient shareholders. In October of 1988, Johnson shocked the financial world by announcing a management-led buyout proposal. His offer? A staggering $17 billion. Now, a management buyout, or MBO, is typically where a company's existing leadership team acquires a controlling stake. But this wasn't just any MBO. Johnson's plan was a leveraged buyout, meaning it would be financed primarily with borrowed money. This huge debt would then be paid down using the company's own assets and future cash flow. While innovative, it immediately raised eyebrows. Critics whispered about potential conflicts of interest, arguing Johnson was trying to buy the company on the cheap to the detriment of existing shareholders. News of Johnson's $17 billion bid sent shockwaves through Wall Street. It was an enormous sum, one that instantly sparked a feeding frenzy among the financial predators of the era. The price seemed high, yet the whispers began. Was RJR Nabisco worth even more? The sheer audacity of the offer signaled that this was a company in play, a prize ripe for the taking. And when a giant like RJR Nabisco is in play, every major player wants a piece of the action.
Enter Kohlberg Kravis Roberts, better known as KKR. Led by Henry Kravis and George Roberts, KKR were the undisputed pioneers and kings of the leveraged buyout. They had built their empire on the premise that underperforming public companies could be bought, restructured, and resold for massive profits. Kravis, known for his relentless pursuit of deals, saw Johnson's bid not as a done deal, but as an open invitation. KKR was about to unleash its full arsenal. KKR quickly assembled its own consortium and submitted a counteroffer, a staggering $20.3 billion. This wasn't just a slightly higher bid, it was a declaration of war. Their strategy was textbook LBO: identify undervalued assets, load the company with debt, then sell off divisions or streamline operations to pay down that debt, ultimately aiming for a lucrative exit. The battle for RJR Nabisco was now officially on, and the stakes had just been raised exponentially. What followed was an unprecedented bidding war, a 25-day marathon of negotiations, counteroffers, and intense strategizing. Other players, sensing the opportunity, also jumped into the fray, including Forstmann Little & Company, another prominent private equity firm, and Shearson Lehman Hutton. The sums involved escalated rapidly, pushing past all previous records. It became a pure test of financial might and nerve, with billions of dollars being thrown around like poker chips. The primary fuel for these monstrous LBOs was what Wall Street called junk bonds. These were high-yield, high-risk debt instruments pioneered by investment banker Michael Milken. Junk bonds allowed companies, or acquirers, to borrow massive amounts of money, even without sterling credit ratings, provided they offered high interest rates to investors. They were controversial, often seen as reckless, but absolutely indispensable for financing deals of this unprecedented scale. Without them, the RJR Nabisco LBO would have been impossible. As the bidding accelerated, the tensions mounted. Ross Johnson, determined to keep his company, raised his own bid multiple times, but KKR, relentless and strategic, kept matching and exceeding. The sheer audacity of each new offer became a major talking point in the media, capturing public imagination and concern. This wasn't just a business deal, it was a public spectacle, a gladiatorial contest played out with billions of dollars.
Amidst the frenzy, questions arose about the long-term implications. While LBOs promised huge returns for investors and shareholders, what about the actual companies and their employees? Critics argued that such massive debt loads forced companies into asset stripping and job cuts, sacrificing long-term health for short-term profit. The RJR Nabisco deal became a microcosm of this larger debate about the soul of American capitalism and corporate responsibility. Finally, after weeks of nail-biting negotiations and a dizzying array of proposals, the climax arrived. On November 30th, 1988, the final, decisive bids were placed. Johnson's team offered a compelling package, but KKR, with a reputation for audacious moves, had one last unexpected gambit. They dramatically increased their cash component, making their offer simply too attractive to ignore. This was the moment of truth, the point where history was about to be made. KKR's winning bid ultimately valued RJR Nabisco at $25 billion. It was a staggering sum, breaking all previous records for a leveraged buyout. The news reverberated globally. It wasn't just a number, it was a paradigm shift. KKR had not only won the deal, but had firmly cemented the LBO as a legitimate, albeit aggressive, tool in the corporate finance arsenal. Ross Johnson, despite his efforts, walked away from his own company. So KKR now owned RJR Nabisco, but at a formidable cost, $25 billion of debt. The real work and the true test of their strategy was just beginning. They faced the monumental task of servicing that debt. This meant a rapid and aggressive restructuring of the company, selling off non-core assets, streamlining operations, and cutting costs wherever possible. The era of the lean, mean corporate machine, driven by private equity, had truly dawned. One of the most immediate and painful consequences of the RJR Nabisco LBO was its impact on employees. As part of the debt reduction strategy, KKR initiated significant layoffs and asset sales. Divisions that didn't fit the core business model were quickly divested. For the thousands of men and women who worked for RJR Nabisco, the promise of corporate stability suddenly vanished, replaced by uncertainty and anxiety. This was the human cost of these monumental financial maneuvers.
The RJR Nabisco deal wasn't just a single transaction, it was a blueprint. It demonstrated the immense power of private equity firms to raise capital and execute deals on an unprecedented scale. It proved that no company, no matter how large or iconic, was truly safe from a determined bidder armed with enough debt financing. This was a turning point, signaling a new era where financial engineers, not just industrial leaders, dictated corporate destinies. The widespread media attention around the RJR Nabisco deal, fueled by books like Barbarians at the Gate, brought the mechanics of LBOs into the public consciousness. It sparked fierce debates about short-term gains versus long-term value, the ethics of hostile takeovers, and the role of debt in shaping the economy. For better or worse, the deal became synonymous with the aggressive, high-stakes capitalism of the 1980s. Perhaps the most enduring legacy of the RJR Nabisco LBO was its impact on corporate governance. Before this era, many companies prioritized stability, employee welfare, and long-term growth. But the LBO wave, epitomized by RJR Nabisco, pushed shareholder value to the forefront. The idea was simple. Management's primary duty was to maximize returns for shareholders, often at the expense of other stakeholders. This philosophy quickly became a dominant force. The success and the controversy of the RJR Nabisco deal opened the floodgates. Private equity firms, emboldened by KKR's triumph, began to target other major corporations. The LBO model, refined and perfected, became a standard tool for corporate restructuring and wealth creation. It marked the definitive shift from a managerial capitalism, where companies were run by their executives, to a financialized capitalism, where investors and financiers held ultimate sway. However, the story wasn't without its dark side. The junk bond market that fueled these deals eventually imploded in the early 1990s, leading to bankruptcies and financial ruin for many. Michael Milken, the junk bond king, faced federal charges for securities fraud. This downturn showed the inherent risks of over-reliance on massive debt and the speculative nature of some of these financial instruments. Despite the later challenges in the junk bond market, the core principles of private equity and leveraged buyouts endured. Firms like KKR continued to thrive, evolving their strategies. They adapted, learned from mistakes, and continued to reshape industries. Today, private equity remains a formidable, often invisible, hand guiding the destiny of countless companies around the globe, a direct legacy of the battles fought in the late 1980s. The RJR Nabisco LBO was more than just a deal. It was a defining moment. It was a clash of titans, a battle for corporate control, fought with billions of dollars and mountains of debt. It pushed the boundaries of what was financially possible, showing that even the largest and most established companies could be bought and transformed through the sheer force of financial engineering. It taught us that, in the relentless pursuit of profit, old loyalties and corporate traditions could quickly be discarded. The focus shifted irrevocably from building products to building shareholder value, from long-term vision to quarterly performance. This one deal laid the groundwork for the financial landscape we inhabit today, where private equity wields immense power, often far from the public eye. So, the next time you hear about a major corporate acquisition or a company going private, remember the lessons of RJR Nabisco. Remember how a single, audacious deal, fueled by unprecedented debt, unleashed a new era of corporate power and forever altered the relationship between capital, management, and the very fabric of our economy. It was a true financial earthquake, and its tremors are still felt today. Thank you for joining us on this journey through one of financial history's most compelling stories. If you found this deep dive into the RJR Nabisco LBO enlightening, make sure to hit that like button and subscribe for more explorations into the forces that shaped our economic world. We'll see you in the next one.